Morning, good evening, good afternoon, wherever you are. Welcome to Flying with Phoenix speaker series. This is the 8th episode hosted by LTF Ventures here at the University of Chicago. LTF Ventures is a student-run VC at the University of Chicago. My name is David. I'm president of the organization. And the Flying with Phoenix speaker series launched last year. We intend to bring industry leaders and investors to come and engage with the Chicago entrepreneurial community on all questions pertaining to business and entrepreneurship and the world economy. It is our great honor today to have another David, Mr. David Rubenstein, to join us today for the next 1 hour. So welcome, David, to LTF.
Thank you for inviting me. My pleasure to be here.
David is a speaker that doesn't really need any introduction, but I'm going to give a little bio for him anyway, so that people knows his background and can frame our conversation going forward better. So David Rubenstein is the co-founder and co-chairman of the Carlyle Group. It's one of the world's largest and most successful private investment firms. Established in 1987, Carlyle now manages over $293 billion from 26 offices from the world. David is the board chairman of John F. Kennedy Center for Performing Arts, the Council on Foreign Relations, the National Gallery of Art, and the Economic Club of Washington. David is also a trustee here at the University of Chicago, where he received a JD from the law school in 1973. He, like many of us, has survived and thrived in the U Chicago winter. So please join me for a virtual welcome home for David.
Thank you.
Okay, so I guess the first question is that you've interviewed so many leaders, both business and political ones, in the past. How does it feel like to now be in the seat of the interviewee instead of the interviewer?
Well, there's less pressure because, I feel less pressure being an interviewee. When you're the interviewer, I don't want to put pressure on you. But if things don't work out, they're going to blame the interviewer more than they're going to blame the interviewee, right?
Right. That's absolutely true. And your show, the David Rubenstein show, which we're a big fan of here at LTF, actually inspired very much this speaker series. We thought, why don't we also invite a speaker and ask them very frank and honest and sometimes funny questions like you do on your show? So I'm just curious, how did you come up with the idea of peer-to-peer conversation in the first place? And who is like the most interesting people you have interviewed in the past many years?
Well, as you all will find out, if you don't already know, the best things in life often come about through serendipity and not by planning and careful preparation in some respects. So what happened was, as the head of the Carlyle Group for many, many years, and as the founder of it, really, one of my jobs was to get speakers who would be very good at our annual meeting, where we would have 1,000 people coming. And if you want to draw 1,000 investors, you usually have to have more than David Rubenstein saying how great the investment is. So I would hire former secretaries of state, presidents of the United States, famous people, and pay their speaking fee. It turned out that they were relatively boring speakers.
Okay.
And so I kind of decided what I would try to do is liven it up by interviewing them. And I asked the speaking agent people whether that would be a problem. They said, no, as long as you pay the same fee, we don't really care. And it's easier for them to just answer questions. So I started doing that. I realized I had the ability to make a lot of these people look funny and humorous. So I thought that worked out. Then I later was asked to be the head of the Economic Club of Washington. And it was the same drill, get speakers, in this case, for people who are in the Washington, D.C. business area. And it turned out the business people weren't very good speakers either. So I decided to go to the interview format, and it seemed to be popular. The club membership went from like 100 to 1,000. And Bloomberg saw it and heard about it, and they asked if I'd go on TV and do it. And so I said, okay, and it wasn't that hard. So they came up with the title peer-to-peer, but the implication is that a journalist wouldn't be typically a peer to somebody he or she's interviewing. But many of these people are people that I have known, they're friends of mine, or I've interviewed them in many different contexts. So they kind of called it peer-to-peer, and it seemed to work out. So I now do that. And last week I interviewed the CEO of TikTok, and that's now on the air. And then I just interviewed the head of Airbnb. I think that'll be broadcast soon. And I just interviewed this week the chief of staff of the White House, and that'll be broadcast soon. And so I do that. And then I have another show that I do on investing that's just started, where I interview great investors and great business and financial people. And then I have another show on history that I do for the PBS on American history. And finally, I'm doing a large PBS series on American history and iconic American symbols, and that'll air next year. So I do a fair bit of it, and I enjoy it. It's like a hobby. It's not my full-time job. It takes a small amount of my time, but people see me on the show, and people think I do it full time, and I'm surprised that when I go around the world or even the United States, people come up to me and they say they like the interviews. And many people don't know that I do something other than being an interviewer. They think this is my full-time job.
That's interesting. So out of all those people you interviewed, I think you had Mr. Griffin on your show a while ago as well, or just last week, maybe. But who is the most interesting person?
Well, I think when I interviewed Jeff Bezos, it was in front of a live audience. We have a live audience. You can use humor better, because if you ask a humorous question, the audience will laugh, making certain that the person who is the interviewee will realize it's a humorous question. So I do that, did that with Jeff, and I've known him for a long time. And so we had about a couple thousand people in the audience, and he was very good spirited that day. So that was good. I interviewed Oprah Winfrey, and she's obviously a pleasure to interview. She knows how to be an interviewee as well as an interviewer. One time I did George Bush and Bill Clinton together, and that was, pretty humorous as well. So, it's like asking me which of my children do I like the most. I like all the interviews, but some are maybe slightly funnier or more memorable than others.
What about someone that you really want to interview but haven't gotten a chance to? What would that be?
Well, the Pope hasn't agreed to do an interview yet. I've often thought maybe I should get him. And I've been thinking about trying to interview people that aren't alive. See, we don't have the interview format as a form of entertainment. It's kind of relatively new. There are no interviews for entertainment or information purposes of Abraham Lincoln, George Washington, Charlemagne, Cleopatra, William Shakespeare. So wouldn't it be fun to go and interview William Shakespeare and say, who really wrote those plays? One person could have done that. Or say to Henry VIII, why don't you just get a prenup with your wife rather than chop off her head? It would be fun to do it. So I'm working on a way to kind of get somebody to either play the character of these individuals and then kind of have interviews of people that are no longer alive and in fact never gave the interview.
I would definitely watch that series. Maybe you can interview Mao or some political leaders.
Right. I'd like to see, ask Mao. I have a lot of questions for him.
Okay. So like you said, a lot of people might mistook you for a full-time interviewer, but before you get into interviewing, you actually worked, you still do in private equity. And before that, you had a career in law and public policy for almost 14 years after you graduated from the Chicago Law School, right? Including, I think, a service in the Carter White House as a deputy domestic policy advisor. What is your biggest takeaway from that segment of your career? And how did you think your background in law perhaps helped you to pivot later on to private equity?
Well, I tell students all the time that you can't really know exactly what you're going to do when you graduate from college or graduate school. You can think you do, but most people will probably change their jobs 3, 4, 5 times in their lifetime, and some of them will change their career path as well. And I did as well. I always thought I wanted to go into politics. I wasn't going to be a candidate. I didn't think I had the charm, the good looks, and all the other things you need. But I thought I'd be an advisor. And my role model was Ted Sorensen, who had been the speechwriter and advisor to John Kennedy. And so I always wanted to go work in the White House and be an advisor to a president. Making money had meant nothing to me. I came from a family that had no money. There were no tech startups, private equity firms, hedge funds, or billionaires at the time that I was growing up. And it just wasn't something on anybody's radar screen at that time. If you wanted to go into business in those days, you probably go into your family's business or maybe a very large public company and rise up after 30 years or not. So I just wanted to be a lawyer, go into government, and that was my ambition. I learned a lot working in the White House. When I was 27 years old, I was the deputy domestic policy advisor to the President of the United States. Obviously not qualified for the job, but he didn't think, he wasn't qualified either. He didn't have a lot of experience either. So it was fun. And then I went back and practiced law afterwards when we lost to Ronald Reagan in 1980. I had to go leave the White House. but I wasn't really that good at it, and I wasn't that enjoying it that much. You can't win a Nobel Prize hating what you do.
Right.
You have to, if you're going to get somewhere in life, you have to find something you love. So I encourage people to experiment, find something that you love, not your parents,
Mhm.
something that you really get pleasure out of. And I didn't find it till I was 37, 38 when I started Carlyle. So I spent, many years doing other things, but I enjoyed them, but they weren't passionate for me the way that investing was and building a company was.
Wow. Thank you for that advice to our class and to our students here. There's another thing that we might pick your brain and your advice on, which is about uncertainty. When you graduated from law school in 1973, there was a lot of uncertainty in the air, right? It was, the energy crisis, Vietnam War still going on, inflation was getting out of control. If you look at it today, Chicago graduates and actually all graduates are facing similar, if not greater levels of uncertainty in the world. What would be your one piece of advice to the class of 2022 as they graduate and go into this great uncertainty that we are facing right now?
Well, first, I think almost any time anybody graduates from any college or law school or graduate school, there's always uncertainty. The world is filled with uncertainty. You go back 100 years, 200 years, 300 years, always going to find people saying there's uncertainty, the world's going to fall apart. How's the next generation going to be as good as the older generation? The people always say that when they're older. I would say that the most important thing to do for young people is to, try to find something you enjoy, feel that you're doing something useful for society, perfect certain skills like how to communicate orally, how to write well, keep learning. Commencement doesn't mean you end reading. It means that you're beginning your life as an educated person, and try to find something that you will feel justifies your existence on the face of the earth. If you're here for 70 years, 80 years, 90 years, whatever it might be, at some point you want to say, I did something useful and I justified my having been created. And in my own case, I'm not sure I'm the most productive person, but I've tried to spend in recent years giving back to society through philanthropy, and particularly patriotic philanthropy. But some people say my interviews are better than my philanthropy. I don't know. Whatever it is, I think people should try to find something that they can give back to society, as well as do something professionally that you enjoy. So I would say don't panic. There'll be a job you'll find. You'll probably have many different jobs before you find something you really like. And ultimately, be proud of the fact you went to the University of Chicago. It's a great school.
Thank you, David. As a member of the class of 2022, we really appreciate that piece of advice. So if we go look a little bit at the beginning of your private equity career, right? You co-founded Carlyle in 1987, if I were correct.
Correct.
You were 38, and you didn't really had a professional investment experience or a track record at that time in private equity, right? I remember reading about, I think, Steven Schwartzman's memoir that when he started Blackstone, he worked investment banking many years, but he still had the difficulty raising funds just because of lack of track record. How did you overcome that and raise your first fund successfully?
Well, many entrepreneurs are people that don't know how little they don't know. So if you know so much about something, you might say, well, I'll never be able to get this off the ground. So typically people that start companies are people that are younger. They don't know how little they know about how difficult it will be, and they therefore plow through walls. So I'm not comparing myself to them, but Bill Gates, Jeff Bezos, Steve Jobs, Mark Zuckerberg were very young when they started their companies, and they didn't know that they couldn't do what they did. And people told them this will never get anywhere. So in my case, people told me, you are crazy, you're a lawyer, you don't know anything about investing, and Washington is not New York or Chicago, so you'll never get it off the ground. And I just ignored them mostly and just tried to prove that I could do it, but I had very modest ambitions. At the time that I started the firm, I took a lease out on some office space, and the leasing agent said, well, you automatically get for free the right to take some additional space as an option, off to pay a higher price in a year or two or three. And I said, take that out of the lease. I never want to have more than 4,000 square feet. I'm never going to have more than 10 people in a firm. Obviously, I was wrong. I would say that we made a lot of mistakes in the beginning, but we did reasonably well so that we could go out and raise a fund after a number of years. Initially, we did deals deal by deal. We'd raise the money just for a deal. And then after we did about 4 or 5 of them, then we went out and raised the fund. But it took a long time to raise the first $100 million fund.
and now after 3 decades, you really have transformed the organization, right, into one of the largest investment firm in the
No.
world.
Well,
Uh,
we did that. We came up with an idea. I came up with an idea that changed the face of private equity to some extent.
yes.
Private equity, which is another euphemism for buyouts, though you could say private equity subsumes venture capital and growth capital as well. But if you just take the private equity world or the venture world, all the firms were tiny firms. When RJR deal was done in 1989 by KKR, they only had 7 investment people in the entire firm. These were tiny firms. I came up with the idea of having multiple funds. We have a buyout fund, a venture fund, a growth capital fund, a debt fund, infrastructure fund, and then basically use our brand name and our back office to allow each of these funds to operate separately. And then I could go to the investors who were in one fund and say, well, we did well for you here, give us a chance here, and so forth and so on. And then I decided to globalize it by going around the world and building out arms in Europe, Asia, Japan, Africa, Middle East, and Latin America. And so that's how we built the firm up. We had a good track record. If I had a bad track record, we wouldn't have been able to do it, but we had a good enough track record to let people give us a chance to do more and more things.
So that's interesting here, because it's a recent trend where LBO used to be the bread and butter of this industry, and the growth equity and the private debt, part of it only came in, I think, this past decade. A lot of firms started to adopt that. LBO is only now less than 50%, I guess, of the total transaction of the industry, while growth equity and others account for the rest. But when you started in '87, you already had the idea that you want to go into not just LBO, but other departments as well. Are you not afraid of competition from existing players in those fields? What about Sequoia on VC scenes, or what about larger Tiger on the growth equity scene? How do you compete with them in multiple fronts at the same time?
Well, of course, when we were starting and doing some of these things, some of those firms you just mentioned weren't around, or they weren't as big as they later became. I think if you're afraid of competing, you'll never get anything off the ground, because there's always going to be somebody you're going to compete against. So you basically say, look, we have a special way of doing it. We have a different way of doing it. We've made money for you before. Give us a chance here, and so forth. And I didn't say we were going to try in the venture world to beat Sequoia and so forth, but we have our own way of doing it, and it often worked out. You were right about private credit. Private credit really came about, I would say, and for those who aren't familiar with it, there's always been fixed income investments, of course, but they tend to have single-digit rates of return. When the Great Recession happened, a lot of debt went bankrupt or went down in value, and a lot of people bought it at big discounts. And then when the world came back, the debt produced double-digit rates of return, 20, 30%. So people said, well, we can buy debt in a distressed way or in some other kind of manner and ultimately get good rates of return. So that began to make everybody think they should get into the so-called private credit business. And one of the advantages of the private credit over private buyouts is that it takes fewer people to manage money. So you don't need as many people as you do in the buyout business. So if you're a publicly traded company and you want to show higher margins, as investors in your company often want, you can have relatively high margins because you don't use that many people to make the investments. It's not as staff intensive as buyouts, for example.
Great. And while we're still on topic of LBOs and buyouts, and there's a big risk that everybody's talking about right now. I think you've been asked in the past as well by journalists, is the interest rate hike that's coming this month and perhaps a couple more times this calendar year. How do you see the private market will adapt to this high interest rate environment? And under this new interest rate, do you think the private market return can still stay above the market for the long run?
Right. Okay. First, this isn't high interest rates. High interest rates is when I was in the Carter White House and we had inflation of 15%, and I'd say the federal discount rate was as high as 20%. Those are high interest rates. What we're talking about is taking interest rates are essentially flat, yes, in terms of real terms, and increasing next couple of weeks, increasing it by 25 basis points, which is nothing. And even if the Fed and the chairman of the Fed used to work at Carlyle, I hired him out of the government many years ago. He was very good, and then later left, and now is the chairman of the Fed. I don't have any insights in what he's going to do, but my impression from interviewing him and from public information is that we'll probably have a number of 25 basis points increases this year. But even if we have 5 or 6 of them, it's still going to be a relatively low interest rate. So there's no doubt when interest rates go up, asset prices go down. but I don't think we're going to have very large increases in interest rates compared to historic norms. And secondly, it's all been discounted. When Paul Volcker became the chairman of the Fed in 1979, when I was in the White House, he increased interest rates over a weekend by 200 basis points. Well, and nobody was expecting it quite that big an increase. So now the Federal Reserve telegraphs exactly what it's going to do. Jay Powell said the other day, here's exactly what I'm going to do. Not a 50 basis points increase, but a 25 basis point increase. And so the market is already discounted to put it into the market. So I think while we're going through a bit of a correction now, in part because interest rates are going up, in part because of what's going on in Russia, and in part because of energy, I think the market has kind of baked in these interest rates increases. Now, in terms of doing buyouts, the interest rates are less significant than they used to be. When the RJR deal was done in 1989, 95% of the capital structure was debt.
Yes.
Today, probably you might have 40% or maybe 50% of the capital structure will be debt. And it's very hard to default on this debt because they have, provisions that make it hard to default on. So it's not quite as risky as it used to be, and it's much less leverage than it used to be. So I don't think it's going to affect us in terms of defaults very much, or actually make it too difficult to get attractive deals. Now, the rates of return theoretically should come down. If you're paying slightly higher interest charges and you're still paying high prices, you're probably going to have lower rates of return. But prices may come down that more than compensate for the fact you're paying a little bit more in interest.
Right. Thank you for that insight. And last year was a tremendous year for the industry in general, right? Not just Carlyle, but I think a lot of PE firm had tremendous increase in profit and very strong fundraising across the board. Would you attribute most of that, high growth or unexpected growth to the low interest rate that we had for pandemic and all the stimulus that goes into the economy? Or is there something else in play there?
Well, I'd like to say it's attributable to the charm and good looks of the founders of these private equity firms. They're so charming and good looking. That's probably what did it. Yes. But if you don't accept that notion, it might be that the private equity people didn't have to travel around that much. They could do everything by Zoom. So it was easier to raise money. If you already had relationships with people, you didn't have to fly around the world to get the money. That saved time. People were doing deals. And so, yes, the market was probably better last year for private equity than it's ever been in terms of fundraising, in terms of exits, in terms of deals done. So it was spectacular. And the stock prices of the private equity firms reflected that. They all more than doubled last year. I don't know that it'll be that good this year, but I think there are many factors that came about. But one of the most important ones is that when private equity first started, when buyouts first started, they were thought to be very risky, and they were highly leveraged, and they were risky. And the federal government didn't really let people put their money into these deals very easily. If you had a pension fund, you weren't allowed to invest a pension fund in a buyout. Then in 1978, during the Carter years, the Labor Department said it's okay now under the prudent man rule to allow pension funds to invest in private equity or buyouts. And that produced a flood of public pension fund money into this. And then when those returns were very good for those public pension funds, other people noticed, and sovereign wealth funds began to come in, and global pension funds began to come in, high net worth people began to come in, and so you got more and more capital coming in, and it became so popular that in the end, while the rates of return remained pretty attractive, these kind of investments, which were once known as alternative to stocks and bonds, are now mainstream, just as stocks and bonds are. So it's not quite as exotic as it used to be. If you're going to do venture capital in, some emerging market country, that might be a little exotic still. But if you're basically doing buyouts in developed markets, it's not that exotic, and therefore it attracts a lot of capital, and the rates of return are still likely to be pretty good.
But if it is in the case, right, you said, right, the alternatives are now mainstream, and public pension funds, university endowments, wealthy individuals, right, they're all investing in this space, becoming LPs. Wouldn't you expect a convergence of the private and public market return in the space? How do you still generate that alpha if everybody's money is in this space and a lot of new companies?
Well, there is likely to be a convergence in some sense. Historically, let's say over the last 100 years or so, public market in the United States averages, or stock market averages, probably 6%, something like that. Fixed income, maybe 3%, 2 or 3%. Private equity has historically been double digits net returns. And that's because, in part, you are really spending a lot of time adding value to the company. you're doing a lot of things that maybe you can't do in a public setting. So I suspect the rates of return will come down and they'll get closer, but I doubt that they'll be even. So I think in private equity and alternatives need to be, I think, producing rates of return of probably 300 basis points on average better than public market returns to still attract capital. Now, everybody wants to be in a top quartile fund, which is to say the top 25%. And if you're in a top 25% private equity fund, you're probably going to outperform public market indexes by anywhere from 1,000 to 1,500 basis points. So everybody thinks they're going to be in such a top quartile fund. But even if you're not, and you're in an average one, you're probably still going to outperform the public market. So I suspect people will still look for high yields. And as long as interest rates are low, you're going to see more and more money coming into alternative investments, so-called, because people want higher rates of return.
So some people or journalists or newspaper now calls that the PE industry are more and more like they call it financial supermarket, right? You kind of provide all kinds of product. You try to be as big as possible. You are no longer, at least they argue, relying on the performance fee, but rather just the management fee that you charge on the asset that you have. Is that a trend that you think are that characterize the industry reality? Is that
Well,
in the future you can no longer tell the difference between Blackstone and BlackRock because they both offer the same kind of product and have same kind of return?
let's suppose there are roughly 10,000 private equity firms in the world, and maybe less than a dozen are public.
Okay.
So if you're a public, the people that buy publicly traded shares and analysts for them, what they like to do is have the ability to predict your earnings a quarter in advance, a year in advance. The easiest way to predict your earnings is to look at your management fees, because that's going to be there every quarter, every year. You don't know what the performance fees are going to be because they're episodic. So you don't get a lot of credit for it. In fact, some of the large publicly traded private equity firms, the market values their carried interest down the road as being worth zero. They don't give them any credit for it. They just look at your fees. So yes, for publicly traded companies that are private equity ones, they probably are increasingly more fee oriented, I would say, than carried interest oriented. But remember, there are about a dozen of these firms, and there are 9,988 that are not. So for those people, it's very likely that carried interest means much more, and for their investors, it's probably going to be attractive to them because in the end, carried interest, if it's high, is going to mean the returns are very good. So I think what you're talking about is probably a phenomenon that's limited more to the very, very few publicly traded private equity firms.
Right. So there will be a bifurcation of the top performing firms and the rest, right? Basically the crowd.
Well, bifurcation, but also that the private equity firms that are publicly traded, they can't raise money if their performance is bad. They still do good performance, but I'm just saying that they don't get that much credit for their carried interest. And in Carlyle's case, I think we have what's called accrued carried interest of roughly $4 billion, which means we have carried interest that we're fairly comfortable will happen of roughly $4 billion. I think the market value is at about zero.
Right. Okay. Thank you for that great answer. And you mentioned, right, that the stock prices performance of a lot of PE firms, including yours, doubled last year, which means that you're double as wealthy. So how does it feel to be in 1 year double wealth? Does it change the way you approach philanthropy? Is there any project that you would like to do with this newfound wealth that you have in the past year?
Well, when you double your net worth, you get twice as many requests for money from philanthropic organizations. So I'm not sure you're ahead of the game, because people read the newspapers and say, well, your stock went up twice as much. I'm going to increase by more than double what I'm asking you for because you have a lot more money. So I don't feel any wealthier than I did before.
Is there any projects, any either on the side of your patriotic philanthropy, or on the other side that you're looking into expanding your footprint in philanthropy?
Well, patriotic philanthropy is 5% of my philanthropy. It gets 100% of the attention because people aren't fixing the Washington Monument or buying the Magna Carta that much. But most of my money goes to medical research, education, cultural things. So, I expect to continue to do the things I've done in universities. And, I was chairman of the board at Duke University. I'm on the Harvard Corporation board. and I'm on the board of the University of Chicago, and pretty active in Chicago, and I suspect I'll do more at Chicago.
Great, and that's a big boom for any of us here at University of Chicago. We all loved the newly constructed Rubenstein Forum. Absolutely wonderful.
Had you had a meal there yet?
I'm a frequent customer.
Oh, you are?
I
Okay.
go there at least 3 times a week. So
Wow, you should get a discount.
yes, I joke with them, right? I'm also David. I come here so often. Is there anyway I get a student discount?
Well, I went there the other day after a board meeting, and I was going with another trustee, and I said, "You have any tables?" And they said, "Well, take about 15 minutes." I said, "Okay, I'll wait." And they said, "What's your name?" I said, "David Rubenstein." They said, "Oh, okay, we'll give you a seat right away." They didn't recognize it, but I waited anyway.
So there are some benefits being the founder of that.
A little bit maybe.
So for the last 3 decades, right, as co-founder and CEO, you did a lot with PE, but now you kind of stepped down from the day-to-day management. I think it's 2017. You stepped down from the co-CEO role, and now are mostly looking at a strategic decision as a co-chairman. Once you do that, how do you spend most of your time? How do you just walk us through what you do in a week?
I am I guess one of the largest shareholders at Carlyle, so I'm very involved. I'm on all the investment committees. I am the co-chairman, so I'm still involved, but I have set up a family office in New York, Boston, and Washington, which manages my money outside of this. And I've got about 50 people now in various parts of what's called declaration. And so I spend a lot of time, helping to build that organization. I spend time as the chairman of the Kennedy Center, takes some time. And being chairman of the National Gallery of Art takes time. And then I have the television shows, and I try to do 1 book a year. You may have seen some of my books. I have one coming out on the art of investing in September, and I've interviewed the greatest investors in the United States and the world, and we'll talk about that. So I try to do 1 book a year, keep my TV shows going, do my nonprofit works as well, and then build out my family office, and that's what I do.
And that's a lot on your plate. And you mentioned the book you're about to release. That's How to Invest, right? Coming out in September.
How to Invest. It's called Masters of the Craft. So people like, I interviewed John Rogers. He's in the book, but also Stan Druckenmiller, Seth Klarman, John Gray, Jim Simons, people like that. It's a pretty good group of people around. Michael Moritz from Sequoia.
So a couple of other investors, Ray Dalio, I think, also released another.
Ray's in the book too.
Earlier, yes, he's in the book, but he also wrote his own book. I think it's
yes.
Why Nations Fail, or something about macroeconomy and the history of great powers.
Right.
You guys have a friendly competition going on to see whose book would rank higher on the New York Times bestsellers list. Is that a competition?
No, his books are much more much likely to be better sellers than mine. He's written some great books. I interviewed him about the most recent book for my TV show, and it's basically about the cycles of history. And his point is the U.S. is kind of in a down cycle and China's in an up cycle. Unless we do something to reverse it, that's probably going to continue, he would say. His book, I think his book Principles sold 2 million copies in China alone.
Yes. And a lot of them are extremely popular in China. I think the book about Schwartzman also become a bestseller in China. Are you intending to release it in the Chinese market as well?
My books are going to be released. This book, other books have been released in China, but this one will certainly be released in China. And yes, it will be. And I haven't been to China for a while because of COVID, but I hope to get there in the not too distant future.
Great. And David, you mentioned that you also manage a number of family offices, and that's an interesting trend that people observe these days, is that family offices, which in the past are minor players, are now competing directly with PE fund, or sometimes even VC fund, by going directly to companies and invest in them or buy them up. Do you think that's going to be threatening to the PE industry if everybody just set up their own family office? The wealthy individuals no longer give their money to you; they just build their own team, like you are doing right now for yourself.
One thing people don't have to worry about is the private equity firms are going to not do well. You've got very smart people running those private equity firms, highly incented, highly motivated. They'll figure out how to adapt. When they first, when public pension funds were the biggest source of capital, we got a lot of money there. Then the sovereign wealth funds came in, and then some of the sovereign wealth funds said, we'd like to compete. We'll do deals directly. And there's a so-called Canadian model where they often compete directly. I would say the family offices are going to compete directly, but there's plenty of business to go around. That's not that big a problem in my view.
Okay. Okay.
I don't feel sorry. Don't lose any tears for the private equity people. They'll be okay. They'll be okay.
Surely we won't. And you have so much responsibility on your shoulder. But there's also a question that we're curious about, is that a lot of private equity or finance people, after they exit from the firm or kind of step back from management role, they sometimes choose to pursue politics, go back into public life. I think one of your former colleagues is now a governor. Are you thinking about perhaps one day or sooner or later going into politics as well, make a run, a national office?
Well, I'm too young. I got to age a little bit more. I mean, the president of the United States is 79. I just got a couple more years to go. So I'm just going to wait till I age a little bit more.
Okay. Okay. But if you are to go, it would be national office or state.
But look, I think, to be a Glenn Youngkin, I hired him 25 years ago. He was at Carlyle for a long time. He's 53 years old. So he's got a long time to go in politics and did quite well in his campaign. I've reached the point where I have so many different things I'm doing, and I just don't want to give them up and to get beat up by the press for something I might have done or not done 15 or 20 years ago that I didn't even know about. So I would say, no, I'm quite happy where I am. I know the presidents. I've known all the presidents of the United States since Jimmy Carter. I'm happy to give them advice if they want it, but I don't think I'm going to be running for office anytime soon. There's no great demand for somebody running who's been a large figure in the private equity world. I suspect that won't be attractive to people.
Okay. Okay. All right. Thank you for letting us know the thoughts. And I think you just briefly touched upon the fact that China is a big market, not just for books, but for all kinds of industries. There are a lot of competitors coming up in China. And Warren Buffett, a legendary investor, he releases annual shareholder meeting letter every year. I think they just had one last week. I read it. It emphasized again, investing America, right? You and your firms are both big proponents of investing America, just like Buffett. So what sectors of the US economy are you most bullish about? Do you think that they are still able to thrive in the face of growing competition, especially from China?
Well, the US has a very large population, therefore a large consumer base. We're the third biggest population in the world. We have a rule of law, which makes it easier for people to kind of know what to do and how the laws are going to work and the investment rules are going to work. But I think our greatest strength is we have an entrepreneurial mindset in this country. Right. We've had it for centuries. And we have a lot of people who are willing to try to build great companies, and we have capital to make it possible for them to do so. So I think the country has a lot of strengths, but clearly we've got some income. We have significant income inequality problems. We have too much federal debt. We have the federal deficit is still too high. We still have a lot of racial problems in our country. So it's not a perfect situation, but I think it's probably still a pretty good place to invest, because if you could invest anywhere in the world, and you can only invest in one country, I think the U.S. would be clearly the country we want to invest in. China is a place where Carlyle has invested a lot of money, but clearly there's some challenges in investing in China now, I would say. The emerging markets haven't done quite as well in the last decade as people thought they were going to do. So, because of the rule of law, the transparency, the quality of investment professionals, the financing opportunities, the public market strengths in the United States, I don't think you can beat the United States, despite the fact that we have from time to time, some challenges.
And speaking of those challenges or difficulties you might face in the Chinese market, one of them is regulatory risk. And as you probably that in the past 2 or 3 years, those risk has been heightened because of the trade war, because of changes in the U.S.-China relationship, and so on and so forth. And last year, I think there was a bid by Blackstone to buy a big real estate firm in China that was blocked by regulators. And for you and for other global investors who are trying to navigate this environment, how do you actually approach it? How do you understand what sector is going to be okay to invest in, what sector is going to have a lot of risk?
Well, in many ways, the greatest political risk for a firm like mine is in the United States. We invest more in the United States than anywhere else. And as Will Rogers once famously said, the country's never safe as long as Congress is in session, because you never know what Congress is going to do. So remember years ago when all of a sudden Congress got upset that I guess a Chinese company or an entrepreneur bought some ports, or was buying some ports, and there was thought that all of a sudden our ports were going to be owned by the Chinese or something like that. You know, the Congress did some crazy things in many respects. So whenever you're looking at a country to invest in, you do have to assess political risks and potential legal risk. But in the end, if you're investing in big companies, big countries, generally you're going to have a lot of people working with you to make certain that things that are not, things that don't happen that are ridiculous. But there's no doubt that China has some regulatory and I would say country risk right now, for sure, in certain areas, not all of them. I would say a number of other areas around the world have some challenges for sure, but we have them in the United States too. So all you can do is do the best judgment you can to assess the risk. And remember, and most of the investments we're doing, they're long-term investments. So even if there might be a short-term problem, if you're holding to something for 5, 6, 7, 8 years, it's very hard to predict that far in advance what the political risks are going to be.
That's correct. And you said in the past you visit China often, right? You will try to speak with those regulators and leaders on their outlook. And
right.
Does that still happen in the age of COVID? Do you guys?
I haven't been to China since COVID. But when I did go, I would often meet with regulators to kind of explain what we were doing or hear their views. And we had people who were knowledgeable about those issues. So I do think in any country you're investing in, including the United States, you need to really know what the regulators are thinking and the legislators. Otherwise, you could make some big mistakes.
That's right. That's correct. And one thing that the regulators in China did not like is cryptocurrency. I think they put a ban on it last year, but it's thriving in a lot of places in the world. Singapore made it a big hub. US, there's a lot of startups and people are very heavily trading on it, young people especially. What is your view on cryptocurrency in general? Do you think it is worth something? Is it a medium of exchange? Is it a hedge against systematic risk of the public market, or is it just speculative? Do you own any cryptos yourself?
I don't own cryptocurrencies, but I do through my family office. I have invested in companies which provide the infrastructure for cryptocurrency trading or other kinds of things that cryptocurrency does, and I'll invest more in that area. Cryptocurrencies reflect a desire on the part of a lot of people to have a currency or a form of value that isn't subject to government oversight so much, that you can move around the world relatively quickly, that is appealing because it's exciting and new. People love new things. There are people, my generation or so, who used to say these things are worthless, but not that many people are saying that anymore, in part because they see that the currencies that are issued by governments like the United States are being devalued from time to time by inflation and other kinds of forces. And as a result, people say, give me something that I can move from one border to another. The government doesn't know about it. And some people probably aren't paying their taxes. And maybe that's the motive for some things, but it's like kind of counter culture to some extent. Some people who are younger just want to have a certain percentage of their assets in something that is different and that might increase in value. I would say, younger people seem to be more bullish on buying these currencies than older people, though some older people have bought them as well. So they're not going away. China has banned cryptocurrencies in China, but how many Chinese people have accounts outside of China in cryptocurrencies? I think the answer is probably a fair bit. So I don't think you can. I think the genie is out of the bottle. I think it's too late to get rid of cryptocurrencies. Just a question of how you're going to regulate it, but you're not going to get rid of them, in my view.
But if it is indeed, as you said, right, a counterculture, it's challenging the fiat currency by nation states, wouldn't they eventually have to crack down on either combined, to together crack down, or individually on the big market to limit the use of if it is conducive to tax evasion, like you said? Would that be a concern?
Well, it's a concern. I mean, obviously, tax evasion is not something you want to encourage. Congress is trying to take steps to make sure people report their earnings if they sell and so forth. I don't know how good the legislation is, but I just think that you always have people that want to have something that is, I'd say that they protects them. That's something that somebody can't get to easily, and that gives them some security. And gold used to do that for thousands of years. And now some people think that cryptocurrency is the equivalent of gold.
So with all these, uncertainty going on, if Russia, Ukraine, everything, would you advise young people like us, if you want to hedge against the risk, to buy crypto or to buy gold?
Well, I tell people something like this. If you go to Las Vegas and you're reasonably intelligent, you know you're going to lose money, because if you make money, you're going to put it back in until you prove that if you make money, all of a sudden you think you're a genius, you'll put it back in. Eventually you'll lose because the odds are always in favor of the house. But people go to Las Vegas knowing they're going to lose because they have pleasure. They like gambling. It's just a form of pleasure. Some people like to play golf. Some people like to gamble, whatever it might be. If you buy cryptocurrencies, you should do it, in my view, as a form of pleasure. If it makes you feel good to have 1 or 2 or 3 or 4% of your net worth in cryptocurrencies, you can look at the trading all the day and every day and think you're making a lot of money and you're a genius, fine. But if you put 50% of your net worth in, I think that's a mistake. So I wouldn't say it's a mistake to put a couple percent in, and certainly a percentage that you can afford to lose, because it's like a game. It's like playing golf, or it's like doing something in gambling. You could lose it all, or it's not necessarily going to make you money, but you enjoy it. And so if you enjoy it, then I don't see anything wrong with it.
Okay.
It's not illegal.
It's more of a pleasure spending than it is a hedge investment that you can use to hedge against.
Well, you can pretend it's an investment, but it's I would say make sure that you enjoy doing it as well.
Okay.
And if you lose money, you won't be as upset.
And there is some environmental concern about crypto, especially Bitcoin, right? The largest out of them all, right?
Yeah.
The sheer electricity it requires and consumes to just mine one Bitcoin is enormous. It's equivalent to like a month or something of use.
No, I don't know. For my book, I interviewed Mike Novogratz, who's one of the leading people in crypto, and he was saying that actually, when you do the real numbers, the amount of energy expended for the so-called mining is very, very, very small. I think he was saying is 0.22% of energy consumption. It's very small, so I don't think it's the biggest problem.
I see. But what is the big problem, of course, relating to this is climate change. And I think you did speak with Secretary Kerry recently, I think a while ago, for the interview, and you talk about environment and his career. And it is a great program that faces our generation more than ever, since we are graduating at this age. Our life, for the rest of our life, we'll probably have to deal with this problem on a yearly basis. What do you think that students of our age should do to help combat climate change?
Well, there are many things people your age can do. In my age, I'm probably not going to live long enough to see the benefits of things we're now doing on climate change. But for younger generations, obviously consume less energy that is carbon related. Secondly, talk to members of Congress and other legislators, make sure that they know how strongly you feel about this. Try to make certain in the industry in which you work that the company you're working for is sensitive to this and takes energy reduction steps. Try to do what you can to promote the use of renewable energy and use that in your own life as much as you can. And those are the kind of things I think you can realistically do.
That's interesting, right? Talk about businesses can also, be susceptible to almost this kind of activism from younger people to change their courses. There's this idea of stakeholder capitalism that came out a few years ago from the Business Roundtable. What's your take on? Do you think that the private equity firms, the investment firms, they also have a obligation or responsibility to steer our economy and our society into a more, green, sustainable direction? Are you requiring your investment to be made, to firms that are committed to ESG, or is this something that you think should be left to politicians in DC?
Well, I think nothing should be left to politicians in DC because that's probably not going to be productive. I think that Carlyle has a large ESG team, and it basically it looks at all the deals we do and to see what the ESG problems are, and then if we buy the company, we will impose a ESG tests and so forth to kind of make the company more compliant with ESG standards, and improvements that we can make are very important to us in that area. I think if you don't pay attention to ESG, you're going to be left way behind. I think it's not going to be an easy problem to solve. It takes a lot of hard work to get these things done. But I think your generation is more likely to get these things done over the next 40 or 50 years than my generation, because we're just not going to be around long enough to really make a big impact.
I really hope that our generation are the ones to solve it. Otherwise, there won't be a next generations. And we mentioned briefly the destabilizing effect of the Russian Ukraine conflict that's going on right now across asset classes, and there are many who fear that the rising oil prices as a result of the sanction will add to this inflationary pressure that we are feeling in the U.S. and world economy. What is your outlook on the impact of this crisis that's going on and still unfolding in both the short and long term for the U.S. economy?
Well, for the U.S. economy, I think the impact is going to be less than it will be obviously for the European economy. We're less dependent on Russian oil. We don't get any really of any consequence, and we are energy independent more or less. So it's not a big a deal for us, and we don't really buy any products of any consequence from Russia. So it's not a big a deal to us. For Europe, it's a bigger deal because of the energy connection. I think the overall worry about it is scaring people, and obviously frightening the markets. My own view, and I was on television today talking about this, is that nobody can withstand the kind of pressure that Putin is feeling from his closest advisors, his aides, his business people, people in the streets in Moscow and so forth. So I think he's going to blink. I don't know whether it's in 1 week or 2 weeks, but he'll blink, and he'll basically look for a face-saving way out and say, basically, I made the Ukrainians recognize they can't be a member of NATO, and now they've agreed they're not going to be a member of NATO, which really they weren't going to be anyway. Right. So there'll be some face-saving way out. Putin is not, in my view, going to launch nuclear weapons. That would be too destructive, because we could then launch them against him and wipe him out, and he would know that. So I do think that at some point the Russians will put enough pressure on him to kind of end this, and I think that'll happen in the foreseeable future.
So you're saying that the effect of the war is likely not going to go beyond the border of Ukraine. It's probably going to be ending in occupation, or maybe,
I suspect in the end that Putin will look for an off-ramp, so-called, or a way out, but he needs to have something that he can say to the Russian people he got, and he's now going to be subject to war crime tribunal, so he really is not going to be able to leave the country so readily. One of the issues is, if you seize the oligarchs' yachts and their net worth and other things, do you give it back to them? There are people who think that this money, these assets, should be sold for reparations and given to the Ukrainian people, and I suspect that will happen. So if you're a wealthy guy and you have a 512-foot yacht, and it's seized by the government of some country, don't expect to get it back anytime soon.
Wow. Okay, that's an interesting perspective that we haven't considered. But the reparation, about, yes, and then oligarchs, but mostly in Europe, UK, that those could face consequences too for Putin's action. Wow. Okay. So I guess towards the end of our interview, maybe let's reflect a little bit on the general themes of leadership, and which of course characterize your career and the ones of many people that you have interviewed. What do you think are the common characteristics that define the leaders that you interview, and of course yourself? How has your conversation with those people, be them business or political leader, contribute to your understanding of leadership in general?
Well, when you interview great leaders, you're obviously going to get some insights from them. And one of my books was about leadership, and I tried to distill the lessons I learned from a number of leaders. And, I kind of outlined it in the book. I won't repeat it here, but I do think I've learned a lot by watching these people, preparing for the interviews, and then talking to them. So I think everybody, should find some people they see as role models or potential leaders, and or leaders themselves, and kind of follow what they did. And that's why I think it's very useful to read biographies of people who have been leaders and learn what their secrets were and how you can maybe adapt or adopt some of them.
Okay. I guess there is a live question that's being raised by one of our attendees. It's very specific to career advancement, right? In the past, perhaps the time you joined Carlyle, a lot of young people, they rush to investment banks and consulting firms when they get started in their career. But nowadays, it seems like the PE firms, they have equally good training and can launch someone's career as soon as they graduate from college. Is that something you would encourage young people to do, is to go straight to PE if they're interested in it? Or do you think that spending a few years in investment banks are still worth it?
I think, look, if you're a genius and you have extraordinary maturity and skills and knowledge, you might be able to skip the investment banking phase of it. But I think most private equity firms still would prefer somebody that has an MBA at some point and has a couple years of investment banking experience before they get into private equity. Now, from time to time, people turn out, John Gray, I think, joined Blackstone right out of college at University of Pennsylvania. He didn't go the investment banking route, I believe, and basically, it worked out okay for him. He's now the president of Blackstone. But as a general rule of thumb, I think get some years of experience, maybe some in investment banking, but it can be in a real company, not just an investment banking, but a company that has operational kinds of things or technology things, and then get an MBA. I think MBAs are generally useful. People want to go into business. They're great networking things, great maturity devices. But I'd say if you're a genius and you've got a great opportunity cost in going to business school, then maybe you don't have to do it. My 3 children all have MBAs,
Okay.
and they're all. I think it's good for them to have it.
Is MBA still worth it in today's economy? I think a lot of people are questioning the value of an MBA, but you seem to still support it as being very valuable.
I think spending 2 years getting an MBA is much more valuable than spending 7 years getting a PhD.
Right, that's correct.
7 years in a PhD, boy, that's time consuming and expensive and so forth. My son has a JD MBA from Stanford.
Yes.
I think a JD MBA is a good thing to have as well. So if I had to do it all over again, I would have gotten a business school degree along with my law degree. But at the time, I think in my entire law school class then, maybe 1 or 2 people were getting a joint degree. It just wasn't that popular then.
Great. Thank you for that. And I encourage people to get JD MBAs if they want to go into private equity. I think by the end of the interview, we want to end on a fun question that's a tradition, came out by our board member, Howdy, a while ago when we started the show, is to ask all of our interviewer at the end, if they are to create a vending machine that can supply an unlimited number of something, what would that product be and where would you put that vending machine?
If I could build a company that would do an unlimited supply of what?
If you can create a vending machine, that like one of the vending machines that can supply unlimited number of certain product, what would that product be and where would you put that machine?
Well, I would put it a vending machine that would have pills that enable you to live a lot longer. And so I would love to do that, or a vending machine that would, give you a lot of energy without a lot of calories. That would be a great product as well. Or a vending machine that would enable your brain to work even better than it works otherwise. So, those would be the kind of things I would think would be good.
Wonderful. Well, thank you so much, David, for coming.
Thank you all.
LTF for this meeting. Thank you for the audience who participated and contributed to the Q&A section as a great success. We'll have our next speaker event in April, and please sign up and watch out for those. And David, again, thank you so much for coming and speaking with U Chicago.
My pleasure.
Graduate, and I hope to see you again in campus.
I'll be there at the commencement. Okay, thank you.
Thank you. Bye-bye.